all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the Long-Term Investor. This week's episode was recorded in front of a live audience for CFA Society of Detroit's annual luncheon at the Fox Theater. A special thank you to the CFA Society of Detroit for hosting us, and a special thank you to this week's guest, Morgan Housel, who signed hundreds of copies of his new book for the audience and listeners of this show. More on that in just a moment. Morgan Housel is a partner at the Collaborative Fund. His book, The Psychology of Money, has sold more than 4 million copies and been translated into 53 languages since being released in late 2020. He is the two-time winner of the Best in Business Award from the Society of American Business Editors and Writers, winner of the New York Times Sydney Award, and two-time finalist for the Gerald Loeb Award for Distinguished Business and Financial Journalism. In 2022, MarketWatch named him one of the 50 most influential people in markets. And our conversation here focuses on his new book, Same as Ever. Because if you want to understand the world around us that is constantly changing, looking uncertain, and sometimes even terrible, you have to start by understanding what always stays the same. Now, if you want a chance to win a signed copy of Morgan's new book, here's what to do. You're going to go to peterlazaroff.com/free book. Now, when you get there, you're going to see a big image of my book because really, I wasn't expecting this surprise giveaway. So if you just go to that page, fill out the form, you're going to get an email confirming your mailing address. And at the end of the month, 10 winners will be chosen for a signed copy of Morgan's new book. And as a consolation prize, I'll mail everyone else who fills out the form a little something special. Now, when you sign up for the book, you're automatically going to be added to my newsletter, and the winners will all be announced in the December 13th edition of that email. Now, without further ado, here is my conversation with Morgan Housel. Detroit, thanks for having us. Morgan, thanks for being here.
Thank you, yeah.
Welcome to the Long-Term Investor.
Thank you. A quick comment. I don't know if people in the room know this, but most CFA annual events are held in like the back of an Olive Garden. So this venue is truly something amazing. So thank you to everyone who set this up today. This is such an amazing venue.
And Morgan, I don't know if you guys watched him sign all those books. I don't know if you've had an opportunity to read any of the chapters. The chapters are very short, very quickly digestible. I had the opportunity to read the book a couple weeks ago. Absolutely wonderful. And the introduction had mentioned The Psychology of Money sold over 3 million copies, translated into 50-some different languages. How did you decide what to do next after something that was clearly a huge success?
Well, I mean, the first was you have to keep your expectations in check and realize that that's probably going to be the peak of it and probably not something that you could follow up. So I've been a financial writer for my whole career. And it was apparent early on, and this will not be a surprise to many in the room, how bad the industry was at forecasting. The next bear market, the next recession, whatever it was. The track record is pretty abysmal for the whole industry. Fund managers, economists, whatever it is. And so there's two things you could do with that insight, with that realization. You can kind of become a cynic and just say nobody knows anything. Or you could say, well, what do we know is not going to change? We really have no ability to predict the change, the big change, particularly the events like COVID or 9/11 that move the needle so much. Nobody can predict those things. So let's put all of our emphasis on what we know is not going to change. That was kind of the first part of it. The second part that really got me interested in this is my favorite finance book that's ever been written is a book called The Great Depression, A Diary. And it was a diary that a lawyer named Benjamin Roth kept during the Great Depression in the 1930s. He was a bankruptcy attorney in Youngstown, Ohio, and he just kept a very detailed diary about what he was seeing going on during the Depression. And his son published it in 2010. And there is a point in this diary in 1932, which was the bottom of the Depression, where Benjamin Roth writes, if you change the dates from 1932 to 1894, everything aligns. What happened in 1932 is exactly what happened in 1893. And it's exactly what happened in 1875. All of the other depressions, it was the same story, exactly the same. And then reading a couple pages later, it occurred to me that if you change the dates from 1932 to 2008, it would seem like it would fit right in. So it's just an observation that like the details change, the actors change, but it's the same movie over and over and over again. And not just for like big depressions, but I think it's true for bear markets, like all financial cycles. There's so much to learn, not the technical details of what happened, but just the behaviors that took place have not changed for hundreds of years. So let's put all of our emphasis in that rather than pretending that we can predict the big changes of what is going to cause the next bear market or the next recession. That's really where it came from.
And yet we're always so focused on whatever the new thing is. Why is that? Why are we so drawn to that? Why wouldn't we want to think more in the lines that you've outlined in this new book?
I think for one, it's exciting to predict the change. If you can do it right, it's extremely lucrative. If you know exactly what the next industry, what the next company is going to be, that's, of course, a very lucrative endeavor. So we're always going to be drawn to that. I also think there's a sense of if you admit to yourself that we don't know what's going to happen next in terms of the specific changes, that discomfort of uncertainty is really hard to deal with. And the idea that we can predict it removes that uncertainty in a way that feels great. And I do think that a lot of the prediction in the financial industry is implicitly at least designed to reduce that uncertainty that's so uncomfortable for people. So even if the track record is what it is, it's never going to go away, both because it can be so rewarding for the few who can do it right, and because the opposite of it, the admitting that we don't exactly know, is so painful. And one really important point here too is that the financial industry, and this is true for many different fields, politics, medicine, all kinds of things, is actually very good at predicting the future, except for the surprises, which tend to be all that matter. Because what moved the needle more than anything in the past 25 years in the economy? 9/11, Lehman Brothers, and COVID. By an order of magnitude, those were the three events that just completely changed the world. And the common denominator of all three of them is that nobody saw them coming, particularly 9/11 and COVID. Not in any economic outlook, no analyst forecast, and moved the needle more than everything else that came before it. So it's not that we don't have any ability to track the economy. It's just that once a decade, there is an event that was impossible to predict that completely and utterly changes what's going on in the world.
And there's a quote in the book that you use from Carl Richards that I love, that risk is what's left when you think that you've thought of everything else. When I read a statement like that, I say, yes, of course. How can we convince those who aren't as open-minded, though, of that statement's truth?
I think this is where a lot of history comes into play, because beyond 9/11, Lehman, COVID, you could also throw in Pearl Harbor, of course, a lot of the political developments of shutting the gold window off in the 1970s, like the really big mega economic events were things that just by their nature, you could not see coming. And so that's the biggest lesson from economic history, is that risk is what is left over when you think you've thought of everything. So it's good. It's a great thing to do, to analyze all of the risks in front of you and try to come up with a probabilistic analysis of how they're going to impact you. That's a great thing to do. At the individual level too, what are my individual personal financial risks in front of us? Great. But then you have to accept that after you're done with that exercise, the biggest risk is what's not on that paper. And it's always been like that. And you can state with certainty that the biggest economic event of the next 12 months and the next 5 years, the next 10 years, is something that nobody in this room or this entire industry is thinking about. Because it's always been like that. I don't think there's ever been a single 5-year period in which the biggest risk in hindsight was foreseeable. One of my favorite examples of this is The Economist magazine, which is such a great publication. I think it's the most astute financial journalism that exists. Every January, they publish an edition that is a preview of the 12 months ahead. Here are the global economic risks for the 12 months in front of us. They've done this for 100 years, every January. Their edition in January of 2020 does not say a single word about COVID, which, of course, nobody was talking about. When they wrote it in December 2019, nobody could have known. And their edition in January of 2022 does not say a single word about Russia, Ukraine, or oil prices, which, again, of course. And then, of course, if we're looking at this year, Hamas and Ukraine and whatnot, like the things that are actually a big needle-moving event with the most astute financial journalists in the world, in hindsight, are never in there. And that's not a criticism of them, because they're very smart people. It's just to highlight that these things that we can't see coming are the things that only matter the most.
And when you have something as quantifiable as investing, and you can look at a statement every quarter and say, of course, this was going to happen. A really common example that I feel like I run into with people is, of course, interest rates were going to go up and bond prices were going to fall. But if you look at the dot plots that the Federal Reserve publish, they didn't even know they were going to raise rates the way that they had to. And I think another point that you make throughout the book, and you even mentioned it just now, when you look back with perfect hindsight, is you don't realize how fragile the past was. Yes, we see this outcome, but it is just one of the many infinite outcomes about that. Can you share some of your thinking on that topic?
I started thinking about this a couple of years ago when I was watching an interview with David McCullough, who is one of the great historians of our time. I think he passed away not too long ago, but one of his many books was about the Revolutionary War. And there's a point in the Battle of Long Island during the Revolutionary War where George Washington and his troops were cornered by the British. And all the British had to do was sail up the East River, and they would have cornered George Washington, and it all would have been over. But it didn't happen because the winds were blowing in the wrong direction that night. So the British could not sail up the East River. And George Washington and his troops got away, regrouped, and then the rest was history. So David McCullough is being interviewed by Charlie Rose, and Charlie Rose says, if the winds were blowing in the right direction that night, would the British have won? And David McCullough said, absolutely. And then Charlie Rose says, no United States of America in that scenario. And he says, I don't think so. So literally just the existence of this country relied on the winds blowing in the right direction in Long Island during this one night in the 1700s. And I think there's so many examples of that in history where this tiny little know-nothing event that nobody thinks anything about utterly changes the path of history. A week or two before he was sworn into office, FDR was almost assassinated. There was an assassination attempt. The mayor of Chicago was standing next to him and actually took the bullet, and he died. And so here's another alternative history. If the bullet was 6 inches to the other direction, probably no New Deal, which still has a major impact on the economy today. You could list dozens of these things of if one little tiny variable went a millimeter in the other direction, everything completely changes. And I think when you immerse yourself in those kind of stories, it humbles you in your ability to try to predict what's going to happen over the next 10 or 20 years. When you realize how ridiculously fragile, not just the economy, but the entire world is.
Well, a good understanding of history is really important to making any sort of judgment of the world. But a lot of times you're going to see the world through the lens of your own personal experience, something that you've written about a lot in the past, you talk about in the book. And we all think that the world works the way that we see it, but the world is massive. There's no way that we can know even 99% of what's going on beyond our little bubble. How do you think that plays into this?
I mean, nothing is more persuasive to you than what you've experienced firsthand. And since everyone has experienced 1/1,000,000% of what's happened in the world, every one of us, myself, everybody, is blind to a lot of how the world works and what is possible and how other people think. And so, yeah, it's a major point. One of the criticisms that I thought was a valid criticism of Psychology of Money was it's written through the lens of a college-educated white American male. And my response to that was like valid criticism, but of course, because that's what I am. Everyone is seeing the world through the lens of their personal experiences. And you see this a lot with, it's been very well studied and documented, the generation who grew up during the Great Depression, how that scarred them for the rest of their life. And relative to the generation before or after them, if you were particularly a young adult during the Great Depression, that stayed with you forever. And your willingness to take risk, your willingness to avoid debt, it stayed with them forever. So everybody wants to think that you are analyzing the world objectively and you're just looking at the data and it's telling you what to do. But all of us view that world through the lens of our own experiences. One of the ways I saw this last decade was after the financial crisis of 2008, when the Fed was printing a lot of money, gold became very popular for a period of time. And there are a couple studies that came out that showed what generation was gold popular with almost exclusively. And it was not our generation. It was the baby boomers who came of age in the 70s and 80s and remember 15% inflation, remember 16% mortgages, which our generation, we could read about it, we could try to empathize, but if you don't have the scar tissue of dealing with that in the 70s, even if we're looking at the same data, it's totally different. The other thing I've always thought was interesting is that until COVID, Australia went 27 years without a recession. A full generation with no recession because they had so much demand from China for all the rocks in the ground that they were digging up. And so if you went to Australia before COVID, if you went there in 2019, they viewed recessions as like a theoretical risk. They knew it could happen, but almost nobody, even the grizzled veterans, had never actually experienced it. And you compare that to America, where we've had 3 or 4 recessions, 2 of which were really bad. Completely different view. Even if we're just as smart as one another, we have the same data, the same academics, et cetera, totally different view on how economies work. One other story about this, it's probably a decade ago now. I did an interview with Daniel Kahneman, the psychologist who won the Nobel Prize in economics. And he started talking about that idea, how what we've experienced in our own life impacts what we believe about the world. And then later in the interview, he said at one point that he's the biggest pessimist that he's ever met in life. He said nobody is more pessimistic on like just the outlook of humanity than he is. And we said, wow, that's really interesting. Is that because you have all of this insight into how our behavior goes astray? And he said, no. He said something to the effect of, I'm a pessimist because I grew up in Nazi-occupied France. And I saw from an early age how evil people could be. And of course, that's not an experience that I had, but that was what he grew up with, the emotional and mental scars of that lasted through today. He's in his 80s now. So everyone has some version of that, of an experience, a really good experience, a really bad experience, that we think we're viewing the world objectively, but when you actually talk to other people who have had different experiences, we're all just viewing it through our own lens.
And what's interesting is I would think a lot of people feel like perhaps they have a bigger view into the world today because of things like social media. You make an excellent point in your book about how news has changed over history and how that influences both what we are paying attention to, but also social media has algorithms to show you what you want. So your experience is still highly differentiated. You still aren't seeing everybody's. And in an era like now where there's a lot of inflation, if you're locked in a 30-year mortgage, maybe you don't care. The interest rates are higher. I mean, this is the way that the economy is going right now, people are having very different experiences. Some feel like we're in a recession, depending on where you work. If you are a mortgage broker, you're probably not loving life right now. If you have a locked-in long-term mortgage and a solid job and no debt, this is great.
Right. I mean, here's one example of that. The CPI index is an index of kind of like average spending. They weight it by how the average household spends their money. Okay, the average household spends 17% of their income on groceries, whatever the number is. I'm making that up. And that's how they weight it. Well, by definition, then, that weighted average applies to nobody. Nobody is average. It's the right way to do it. But this is why I think there's a big subset of the population who thinks the CPI is a scam, because it doesn't map perfectly to their household spending. And these numbers might be a little bit off, but I think it's roughly a third or a quarter of U.S. homeowners own their house outright, no mortgage. Well, what percentage of CPI is housing prices? 25%, in that range? So for a quarter of Americans, a quarter of CPI doesn't even apply to them. It's something that they're not even spending their money on. And so if you take somebody who is in college and commutes a lot and has a gas guzzler and compare that to someone who is retired and drives 1,000 miles a year, everyone has their own individual inflation rate. And that's why your own experiences can be so different from other people. But most people, when they view the CPI and it says it's 4.5%, but they know that their prices are up 10% in the past year, the knee-jerk reaction is the CPI is wrong. It's a scam. They're manipulating the data, when it's actually just an indication of how everyone spends their money differently.
And for nearly 15 years, inflation was so low that we were probably more concerned with deflation. So we didn't notice these differences. The news certainly points them out. They tend to trend negative. Why do you feel that the media is finding ways to be negative so often now?
Well, you said something interesting, that social media gives you what you want. A little nuance, I would say it gives you what you're going to react to, which is like a little bit different. And a lot of times what you're going to react to is not necessarily what you want. It's just what's going to get your attention. And that's a big thing with social media. But also in news, like a big change in the last half century is that news went from local to national to global. And it used to be that every small town had 3 newspapers and it was local news. And yes, you heard about the national stories, but most of what you cared about was the news in Detroit, the news in New York. It was all local. Once that spread and went to national news and then kind of the global CNN, Fox News, where it's talking about everything. If you're in your individual town, what are the odds that someone is going to be, let's say, murdered today in a small town? Very low. Maybe it's 1 a year or something like that, and you'll hear about it then. What are the odds that someone is going to be murdered in the country today? 100%. And what are the odds that there's going to be a really, really out of the blue 1 in a million event in the world today? Also 100%. So once the news spreads to a larger audience, and the news that's going to catch your attention is the bad stuff, well, then you're always going to be flipping on the news and hearing about the terrible things. Because local news talks about the high school football games, but the national news and the world news talks about the terrorism attacks. So once the news spreads to a broader level, even if the world is by and large safer today than it was 50 years ago, the news, I think, can seem much more negative than it was just because that's what's catching your attention. And it's just a much larger sample size to draw from. So I think that plays a big part. The other thing about social media, though, that like a really good algorithmically curated Instagram feed or Facebook feed has been around for like 5 or 10 years. Not that long. So I don't think we fully understand what it does to people's psyches and mindsets. A really interesting thing, and this is a CFA group, so I can kind of go into detail here, the correlation between consumer confidence and an index of economic variables, GDP growth, that kind of thing, was fairly correlated for a very long period of time. And in the last 2 years, it's just deviated by an incredible amount. Consumer confidence today relative to really good unemployment, pretty good GDP growth, stock market doing pretty well, it's deviated today like never before. And I wonder if at least part of that is because even if the economic variables are pretty good today, it's so easy to scroll through your social media and think the world's going to hell. I think that's at least part of it. And it's a pretty new phenomenon that I can't imagine what 2008 would have been like if we had Twitter. I think it technically existed back then, but nobody was on it. It would have been completely different. And in a world where back in the 90s, not that long ago, everybody got their evening news from Tom Brokaw. Everyone's the same. And now it's pick your poison. Whatever you want to hear, that's out there. It's such a new thing that I don't think we know what the ramifications of it are.
Well, and pessimism is more intellectually seductive than optimism, something that you talked about both in The Psychology of Money and in the newest book, Same as Ever. In fact, there was one sentence where I underlined it. I go, wait, was that exactly from The Psychology of Money at some point? Yeah. And it's a great point. I think in general, being an optimist doesn't mean that you are saying everything is sunshine and roses. You can acknowledge bad things will happen. But you often talk about the importance of trying to maintain optimism in some areas. If you're a pessimistic saver, great, and an optimist as an investor, even better. You can almost apply that to all parts of life, don't you think?
Yeah, it's a big barbell. I always refer to it as save your money like a pessimist and invest your money like an optimist. Save with the idea that the next 12, 24 months, 5 years are going to be tough, because they usually are. It's usually a never-ending chain of surprises. But invest your money with the idea that if you can endure that and make your way through, the rewards for investors who can stick around can be great. That seems pretty simple, but I think for a lot of people, getting optimism and pessimism to coexist is difficult. To have that barbell personality is pretty difficult. My favorite example of this is Bill Gates, who back in the 1970s, when he started Microsoft, took the most optimistic swing at the bat that any entrepreneur has ever taken. Where in the 70s, he said every desk in the world needs a computer on it, which seemed completely insane back in the 70s. Very optimistic. On the other hand, he managed Microsoft from day one so that they would always have enough cash in the bank to make payroll for 1 year with no revenue. And through his tenure at Microsoft, through the early 2000s, he kept that promise. He always wanted to be able to run the company for 12 months with no revenue, which is the most pessimistic way you can run any company. So crazy optimistic on one hand and very pessimistic and conservative on the other. And I think that's at least a part of why Microsoft has done so well. It's like they've gotten optimism and pessimism to coexist. The other story that I like here is Mike Moritz from Sequoia, the most successful VC firm that's ever existed. He was doing an interview with Charlie Rose as well. And Charlie Rose says, you've been the dominant VC firm for 40 years. How have you done it? What's your secret? And I loved his answer. He said, we've always been scared of going out of business. And this is a guy who, if anyone in the industry has the right to say, the reason we're successful is because we're so smart. Now, he didn't say that. He said, we're scared of going out of business. It's such a rare mindset that you can be that successful, that optimistic in seed stage venture capital, and still terrified at the same time. It's a very rare mindset, but I think the people who've done well for a long period of time, who've actually gotten their money to compound for a significant period of time, you need both of those, like optimism and survival, to coexist at the same time.
And everybody to buy into your story. You talk about the best story wins. Probably one of the most important ideas, in my opinion, within your book. Can you share some of your thoughts on both how you came to realize that is a true thing, that the best story wins, as well as how it impacts the way that we're going to digest and distill down information?
Well, I think it's especially important in finance, where finance is a very analytical field. Numbers and data and formula. And it's great. That's very important. But it's always the case that not even just in the short term, but also in the medium and long run, the best story wins. Not the best idea, not the right idea, not the right answer. The best story wins. And of course, there's a Ben Graham quote that in the short term, the market is a voting machine. In the long term, it's a weighing machine. But even in the weighing time frame where you're looking at more in the analytical side, there's always a narrative component to investing that is so powerful. And one way to think about this is that every market valuation for the market or an individual stock is a number from today multiplied by a story about tomorrow. That's what every valuation is. A number from today, like 12-month earnings, and then you multiply it with a story about tomorrow of what you think growth is going to be or what you think the risks are going to be. And the story component is so much more powerful than the current year component, than the number from today. It's always way more powerful. So I think that just keeping that in mind, because there are periods like in 2021, 2022, where it seems so crazy. And if you are the kind of person who thinks the right answer wins, those are the periods where you just shake your head kind of in disgust, wondering what's going on. When you realize how powerful stories are to markets, then it makes a little bit more sense of why people would do these. There's another great story here from Howard Marks, who back in the negative interest rate days, he was wiring money to, I think, a bank in Spain. And he wired money, and his lawyer said, oh, you don't want to keep your money in the bank because it's a negative interest rate. You're going to have less money by Monday than you have today. And Howard Marks says, okay, so don't put the money in the bank. And the lawyer said, well, you have to keep your money in the bank. And Howard said, okay, well, then keep the money in the bank. So when we're looking at why do negative interest rates exist? Why are people putting their money into something where they're going to lose? They're going to lose it. There's always just like a narrative side to it. There's a story about it where you're like, oh, okay, maybe it does make a little bit more sense than I thought.
I wrote down the quote directly from your book that you had just mentioned, one of my favorite from the book. Every investment price, every market valuation is just a number from today multiplied by a story about tomorrow. Incredibly insightful. As someone who has to sometimes talk clients off the ledge from a story, we talked about gold already. One of the things that struck me as crypto was really, really picking up steam was how much people who are crypto fanatics sound like the gold bugs that I'd been dealing with earlier in my career.
Are actually the same people.
Well, that's true too. And they don't like to be, though, necessarily compared because it's generationally very different. But even sometimes I wonder, you mentioned Twitter, a lot of people debate factor investing. And yes, there's a lot of data. We can have all the data in the world, but the next 200 years of data might show you a different result. And so at the end of the day, it's just the story that people are buying into. They'll call it economic rationale, but it's just a good story. And in many ways, nobody is better than you at using a story to make your point. You came up with a number of examples throughout the book I jotted. Gosh, you're the one who's turning stories to make your point. Personal finance investing books, they used to be about the blocking and tackling. I don't know that we'll have another classic Random Walk Down Wall Street type book or The Millionaire Next Door type book. What you're writing, I'm actually kind of curious. Do you consider what you're writing to be about finance?
I consider it to be about human behavior, of which finance is a component, but it applies to so many other things. Relationships fall under that bucket. Politics falls under that bucket. Health falls in that bucket. The field that shares the most analogies with finance is medicine, because it has very high stakes and there's a lot of emotion involved. And because of that, there are so many lessons from medicine that when you read it, you're like, that's exactly what people do with finance. Very high stakes, a lot of emotion when you're dealing with it. I view all of that under the umbrella of how do people deal with risk, uncertainty, greed, fear, those kind of things. And what I like about it, of like trying to explain finance through analogies with other stories or with other fields, is that I think it gets you closer to the truth. If you are a financial professional and you are only looking through the lens of finance and economics, I think you're missing 99% of the great learnings that are out there. There is so much that you can learn about money by studying medicine, by studying politics, by studying military history, because all of those fields also fall under the umbrella of how do people deal with risk, greed, fear, uncertainty. And when you realize that that's not part of finance, like how people make decisions around those topics, that's 90% of finance. So there's so much you can learn by broadening your horizons. And I also think as a writer, it's more interesting. Even if you're a financial professional, reading a book that is nothing but charts and data and formulas is dry and kind of boring. But if you can explain it with a story that you're going to remember, hopefully that's more exciting. Everyone remembers in college, you probably had two different kinds of professors. One was memorize the formula the night before the test. And then as soon as you leave the test, you're going to forget it. The other was a professor who told you stories that you still remember today. You're never going to forget them. And so I think that's true for a lot of content. And it's true if you're working with clients as well. If you give them numbers, they're going to forget them in 5 minutes. If you tell them a story, they'll tell their grandkids about it. So I think it's a much more powerful way to learn.
When you're giving financial advice these days, you're in a position to touch so much more than just the balance sheet. Oftentimes, we're having more conversations around happiness. Do you have any observations that you've made over time about the link between money and happiness that you'd be willing to share?
I think one really subtle distinction, but it's important, is that a lot of the studies that will show money does bring some level of happiness. There's actually like an important twist of it's not happiness, that's the wrong word, it's contentment that it brings. And that's actually a very important distinction because people think of happiness as waking up grinning ear to ear, like just walking around smiling. That's happy. But contentment is very different. Now, contentment is worth chasing. To have a life where because you built up some level of net worth, you're now more content. That's great, but it's not happiness. Very different. Happiness is always fleeting. No matter who you are, what you do, nobody is happy all the time. It's a fleeting emotion. Some people are content all the time, and that's great. But happiness is like, if you tell someone the funniest joke in the world, they'll laugh for 30 seconds, and then they're over it. I think that's what happiness is too. It's always just a very fleeting thing. So that's a big part of it. One other thing that I've thought quite a bit about recently is just, there's this great anecdote I love from Will Smith, the actor, where he says, when he was poor and depressed, he had hope that one day he would be rich and the money would take care of his problems. It gave him a sense of hope that he could dream for. And then when he was rich and depressed, he realized that was not the case, that he had more money than he could ever spend, but he still had all the same problems as he did before. He was still depressed. And that removed the sense of hope from his life. So there's this great quote from Rick Rubin where he says something along the lines of, I'm paraphrasing this, he says, you can't become truly depressed until you've met your dreams. Because when you've met your dreams and you realize you have the same problems as before, then you are filled with hopelessness. Now, that's a very pessimistic view, but I think that is true for a lot of money, that a lot of people, the reason that the correlation between money and happiness isn't what you thought it would be. It can actually be kind of a sad thing to realize that after you work so hard and built up this great nest egg, you're not necessarily happier for it. Maybe you're more content. Maybe you have more freedom than you did before. But I was talking to someone the other day who has a very high 9-figure net worth, and it came very quickly. He went from broke to 9-figure net worth because of a giant liquidity event. And he said the day that the check cleared, he realized that he had all the same insecurities that he did before. And those were the things that were actually keeping him up at night and giving him stress and whatnot. None of those would go away. So it's not to say that it can't give yourself a better life, but a lot of the things that are going to actually make you happy are your relationship with your family, your health, your conscience. That's what's actually going to make you happy. And the impact that money can have on those things that move the needle the most, by and large, don't change that much. The one thing that I think money can do that is just a great tool is gives you independence and autonomy. Just the ability to do whatever you want, to wake up and say, I can do whatever the heck I want today. That is massive. But even that, it's not necessarily that that will make you happier. It's that the absence of that will make you miserable. If you wake up every morning, you have to go to work, you have to do your long commute, you have to get yelled at by your boss, and you have no choice, that will make you miserable. And removing that is a giant lifestyle advantage, but happiness is usually the wrong word.
You need money for everything, but money is not actually everything. As we're talking here to a room full of CFAs, I'm curious what you would think someone who's read both of your books would come away thinking it takes to be a great investor.
I think it's two things. One is looking in the mirror and just becoming introspective about who you are and what you want or what your clients want, and realize that it's so very different from person to person. And Peter and I are about the same age, but what you want out of money and how you manage your money might be totally different from what I do. Not because we disagree with each other, just because we're different people. Different risk tolerances, different family goals, different social aspirations, whatever it is. Nobody is alike. And I think there is a problem in finance where when it's taught like math, where 2 + 2 = 4 for everybody, no matter who you are, doesn't matter how old you are or where you're from, there's one right answer for everybody. But finance is not like that. Everyone has very different goals and risk tolerance, what they want out of it. That's a big thing. The second point I would make is just humility for our ability to actually predict these things. And that's such a big point in finance of just the financial history of just looking back and trying to connect the dots in hindsight and saying, how could anyone possibly seen any of this coming? What happened is just a plea for humility. I think those are the two biggest common denominators from the book.
Especially that second one is what makes thinking about the long term so difficult? It's really easy to say, oh, I'm a long-term investor, I have a long-term outlook. It's really, you actually talk a little bit about this in the book as well, the challenges and the fruitfulness of being able to maintain a long-term mindset, whether it's with a habit or your career or investing. Can you share some thoughts on that?
Yeah, I mean, it's one thing to say I'm a long-term investor, and that's great. I am too. But I equated it to, that's like standing at the bottom of Mount Everest and pointing to the top and saying, that's where I'm going. It's like, great, that's a great goal, but now comes the hard part. And the long term is just a collection of short runs that you have to experience and endure and survive financially. So that's really important. So it's much easier to say I'm a long-term investor than it is to actually do it. And there are a lot of people for whom, let's say in February of 2020, they consider themselves long-term investors, investing for the next 10 or 20 years. And then March of 2020, they realize that that is much easier said than done. And those are the kind of people who might panic. For example, it's one thing to say when the economy is going well and the market's going well, to say, if the market fell 30%, I would view that as an opportunity and I would buy more. Great. And then March of 2020 rolls around and there's a virus that might kill you and your family and your work shut down and your kids' school shut down. In that context, it's much harder to do. So it's not that nobody can do it, but saying long-term and actually doing it are totally different things. The other thing that's be relevant for a group of CFPs, I hope, is that it's one thing for you, the portfolio manager, or you, the advisor, to say, here's what's the right thing to do in the long run. But if your clients don't buy into that vision or buy into that plan, buy into that narrative, none of it matters. And the long history of fund managers for whom the fund manager said, this is the right strategy to do, but their AUM walked out the door the next day. And so you can't actually implement it. That's on too. So being long-term too also requires having a client base that actually agrees with that vision that you're putting forward.
Your final chapter of the book has a series of really great thought-provoking questions that I'm inclined to print off and put near my computer just to keep as a reminder. But there's one I wanted to ask you, I think it'd be interesting to hear your response to. And that is, what do you think that we are all ignoring today that will seem shockingly obvious in the future?
The truth is, you cannot answer that question. By definition, you can't come up with an answer to it. So what is the thing that we're all completely ignoring today? So the right answer is who knows? Everyone knows that the interest on the national debt is going up at a very, very high clip. But even if you know it, I think there's probably a sense of complacency just because of the last 20 years, it hasn't mattered at all. That even if you know the numbers and you see it, it's kind of like just watching a house slowly burn. And maybe that's the kind of thing where in 10 years, if we have some sort of budget crisis, however you want to define that, you'll look back and say, of course, it was so obvious. But there's probably some sense of complacency today. But that's the secondary answer to the real answer, which is who knows.
So at the end of your first book, The Psychology of Money, you sort of open up the curtain on your own personal finances, which showcases a pretty high degree of simplicity. I'm kind of curious if you can share how you landed on that. And for those in the audience, I'll put some stuff in the show notes and link to some more posts, but I also have a How I Invest My Money post. You also wrote in the book How I Invest My Money. We're not terribly far off. I'd be kind of curious to hear how you landed on the simple approach.
Yes, I mean, very simply, my entire net worth is cash, a house, Vanguard funds, and shares of Markel where I'm on the board. And that's it. There's nothing else. It's as simple as you can possibly make it. What is not the reason I do that is I'm not the passive index investor who says nobody can beat the market, don't even try. Of course, those people exist. I'm not one of them. I think smart analysts can, and will continue to beat the market. A small percentage of them, but it can be done. The reason that I'm passive is because the variable that I want to maximize for is not what are the best returns that I can earn this year or even over the next 10 years. The variable that I want to maximize for is, can I stay invested in the stocks that I own for the next 50 years? And if you can pull that off, then average returns sustained for an above average period of time leads to magic. So that's the easiest way to actually maximize the dollar amount of your net worth over time. In my view, it's maximizing endurance, not returns. There's this great quote from PIMCO, the bond company, that back in the day, I don't know if they still preach this, but they had this term called strategic mediocrity, which was in any given year, they were never going to be in the top 50% of their peers. But over a 10-year period, they were always going to be in the top 10% because the peers who were beating them in any given year couldn't keep it up. But if you could just be average for 10 years, you're going to be great. And I think that's true. I think if you can be an index fund investor and actually hold it dollar cost average for 50 years, you'll end up in the top 5% of all active managers. Maybe it's the top 10% in that range for doing nothing. It's not to say that it's always going to work. It's not to say it's the best for everybody. But for me, because I wanted to focus all of my time and bandwidth on writing, not picking stocks, not picking the right manager, And because like the more simple it was, the higher the odds that I could have endurance. That's why it made the most sense for me.
I'm curious if there is anything that you've changed your mind on recently.
I think a big one, not necessarily recently, but in the last decade, to that point I just made, I do think that a decade ago, I had a stronger view of this is the right way to manage money, and people who don't do that are wrong. Like, not that strict, but I think that was kind of my view. And now I view it as just everyone's so different that even if you're a degenerate gambler day trading penny stocks, if it works for you, great for you, good for you, have fun doing it. So I think that's what I've changed my mind about is just like, there's no right way to do it. And a lot of the ways that I manage my money, very smart analysts could look at it and say, Morgan, here's the 10 things you're doing wrong. Here's the 10 things you could do better. And most of the time my answer is, look, I don't disagree with you, but I like the simplicity. I sleep well at night if I do it this way. So I almost don't judge how anyone manages their money anymore. If it's working well for them, then go for it.
Well, one final question that I ask all my podcast guests, maybe there'll be some overlap in your response today from what we've talked about, but Morgan, what does it mean to you to be a long-term investor?
I think it means the idea that you know that the path between now and your endpoint, 10, 20, 50 years from now, whatever it's going to be, you know that the odds of your fate are in your favor, that between now and then you're going to do very well. But the path between now and then is going to be a never-ending minefield of surprises and setbacks and recessions and bear markets and whatever it is that, again, you have to experience and survive and endure those. So being a long-term investor doesn't mean that you know everything's going to be great. That's just being complacent. If you think everything's going to be great in the future, that's just complacency. It's just that if you can survive the minefield, that the odds are in your favor. And I said the odds are in your favor, not that the odds are certain. So of course there's a scenario in which even if 50 years from now you've hung on tight and held everything, that your real return stinks. Of course that's the case. It's never happened historically, but of course it could happen in the future. So it's a combination of holding on for dear life and realizing that even if you can pull that off, there's no guarantee in any outcome. I think that's what it means.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.